conversation on Kotak Multicap, a new fund offer. The new fund offer opens from September 8th and will remain open till September 22nd of 2021. To talk about the objective behind the Kotak Multicap new fund offer, joining me now is Mr. Nilesh Shah, Group President and Managing Director, Kotak Mahindra Asset Management Company. Welcome, Mr. Shah.
Thank you, Gitu, for inviting me over here.
Always my pleasure, sir. Starting with the markets, markets are at all-time high. We have seen a broad-based rally, no looking back for the markets since the March 2020 lows that we last saw. What is the way forward for the markets, and what should investors do now?
In some sense, Gitu, market is like our age. They continue to reach higher and higher. In age, every day is higher. In market, many of the days are always higher index. Today, Gitu, we have Triveni Sangam of Sentiments, money flow, and fundamentals driving our market. Sentiments are positive because economy is opening up, vaccination is increasing, COVID cases have remained stable around 4 lakh. This increases positivity. From a money flow point of view, HNI and retail have been big buyers of Indian equity for last 18 months. Mutual funds, insurance companies, pension funds also are net buyers in equity market. And FPIs also have turned buyers in Indian equity market after a record year last year. While it is not fair comparison, but FPIs bought more than 26% of all their investments so far in India in FY21.
Okay.
Now, obviously, after that record buying, they will take some time to digest. But even in this year, they have turned marginal buyer. So, money and sentiments are supporting market. But we know, Gitu, these are all fickle. Money and sentiments can change overnight. What we need is fundamentals. And this is where corporate India is declaring extraordinary good results. In June 20 quarter, at the peak of COVID-19, NSE 500 companies' profit was about 32,000 crore. It went up 2,10,000 crore in March 21 quarter. The growth in profitability of companies has been ahead of investors' expectation or in line with investor expectation.
Right.
For FY21, Nifty EPS is roughly about 550 rupees, which was 15% growth over FY20 earning. And this came even when our GDP degrew. Now FY22 GDP is going to grow positive. The earnings of Nifty company is likely to grow by 38% to roughly about 750 rupees. And thereafter, in FY23, 18 months down the line, it is likely to be between 850 to 870 rupees. Now, this profitability growth is also supporting market. So, I remain bullish on the market because of this Triveni Sangam. And as long as corporate profitability grows, I think market will be supported.
So talking about the Triveni Sangam, the rally that we saw in last 1.5 years has been broad-based with mid-cap, small caps all performing very well. Now, if you can guide us on the portfolio construct of this Kotak Multicap Fund and the sectors and the themes that you will be playing out on, and you find opportunities going forward.
So, Kotak Multicap Fund will always keep 25% minimum in small cap stocks, mid cap stocks, and large cap stocks. And the rest of 25% will be invested opportunistically based on our quantitative model, whether we should put in large cap or small cap. So when small caps are very, very cheap, we will have 25% each in large and mid cap, but 50% in small cap.
Okay.
When large caps are relatively priced better, we will have 50% in large cap and 25% each in small and mid cap. Thus, an investor will always have exposure to broad market across large, mid, and small. Now, today, when we are going to get this money, we will be deploying this looking at market momentum and market valuation. If markets are higher than current level, we will be gradual and calibrated in investing. We will time it over a slightly longer period of time, say 3 months, 6 months. If markets are cheap, lower than current level, we will be investing aggressively. Thus, instead of an investor timing the market, the fund manager will try to time the market in the short run. However, longer run money is made by picking up right stocks. In this fund today, we are looking at couple of themes. One theme is Capex revival. In last few years, investment and capital expenditure has been done by government. Private sector has generally been on the back foot. But now steel sector, cement sector, sugar sector are spending money for building capacity. We believe over next 12, 18, 24 months, more and more such companies will go on spending to create investments. There are some companies which are also catering to export market. So they will have laddus in both hands as they will cater local market as well as export market. We believe industrial stocks over a period of time will do well. The second theme which we are playing out is home improvement. Gitu, in this work from home, we haven't really opened our house for carpenter, electrician, painter, plumber. थोड़ा बहुत मतलब इधर उधर कर लिया, but major काम हमने defer किया. Now we believe there will be opening up of houses for repairing and improvement. On the other hand, primary demand for houses in real estate is very, very strong. In Mumbai, real estate registration दिन दूनी रात चौगुनी बढ़ रहे हैं. Put this together, will there be more demand for cement, paints, tiles, electrical appliances, pipes, fittings, wires, cables? Answer is undoubtedly yes, as people spend on buying houses, as people spend money on improving houses. So home improvement is another thing. The third thing which we are playing now is related to what we call production-linked incentive scheme sectors. Gitu, if you remember in the 80s, Suzuki came to set up Maruti in India, in Gurgaon.
Yeah.
And today's Gurgaon is totally different from that day's Gurgaon. From lush green field, we have ultra-modern factories creating automobiles. And because of Suzuki's, because of Honda's and their local partners, India has become a big player in automobile market. 7% of India's GDP today comes from automobile sector. We are export surplus in automobiles and made in India two-wheelers, scooters, bikes, four-wheelers like motor cars, trucks are visible all over the world. What Suzuki did in automobile sector, a similar thing is happening today thanks to PLI scheme, where companies are coming out of China to set up their base in India. Today we are making assembly of mobile handsets. Tomorrow we will be manufacturing mobile handsets. Today we are seeing multi-million dollar, multi-year deal in chemical sector, just like we were seeing in technology sector in the early days. Today we are seeing emergence of Sri City on the outskirts of Chennai in Andhra Pradesh, which is becoming what was Gurgaon to automobile sector as a hub of electricals and electronic exports. These are all the 2000s of tech sector and generic pharma sector where multi-decade growth is available if you bet on right entrepreneur. So these are some of the themes: home improvement, industrials and Capex revival, PLI scheme, where we are focused in our multi-cap fund.
Sir, lately we have seen lots of interest in the Flexi Cap fund, and asset under management of the Flexi Cap fund as a whole has been swelling. I mean, what is the major difference between a Flexi Cap fund and a multi cap fund, and why would what are the advantage that multi cap fund is offering over Flexi Cap fund?
So under SEBI regulation, a flexi cap fund can invest 100% in any capitalization. If I believe small caps are good, I can put 100% in small cap. If I believe large cap is good, I can put 100% in large cap. However, this decisions in our Kotak Standard Flexi Cap Fund has to be evaluated against the impact cost. My fund is 38,000 crore in size. It is an oil tanker. Can I run it like a speedboat taking sharp turns? Answer is no. If I have to move 38,000 crore from large cap funds to large cap stocks to small cap stocks, I will end up creating huge impact costs. I'll end up taking huge liquidity risk. Instead of giving returns to investors, I will be paying cost to the market. So my Kotak Standard Flexi Cap Fund has become large cap biased. By and large, over the years, the allocation is 75% large cap and 25% small and mid cap. In Kotak Multicap, because size is small, we will be keeping 25% each in small cap, mid cap, large cap stocks as per SEBI regulation. And balance 25% will be allocated based on our proprietary model. In a period like beginning 2018, it will be more large cap biased as small and mid caps were expensive. In a period like March, April, May 2020, it will be more small and mid cap as they were becoming very, very cheap. So to an investor in an ordinary manner, standard flexi cap will be large cap bias stock. A multi-cap fund will be true exposure to large, mid and small, minimum 25% each.
More of diversification in multi-cap fund, right?
Yes.
So you have adopted a model, specific model, for the portfolio that you'll be designing for multi-cap fund. What is this model? How does it work on the fund?
So Neetu, every ship needs an anchor. Otherwise, it will keep on drifting. And what we have realized is that fund managers are obviously emotional human beings. And if we can anchor them with a quantitative model based on past data, that produces best results. This is like a football field where you play within the boundary, or a cricket match where you play within the stadium. Otherwise, you could be way off the target. So we have developed a proprietary model to guide our fund managers when they should be overweight large cap or mid cap or small cap. This model is based on two factors. One is mean reversion on valuation, and the second thing is related to momentum, which defines us how long we should carry a position. Large, mid and small valuations move in a particular direction and they mean revert over a period of time. For example, if large caps are trading at 20 times PE and small and mid caps are trading at, let's say, 10 and 5 PE, it's quite likely that small and mid caps will outperform and narrow down the gap vis-a-vis large cap. On the other hand, if large is trading at 20 PE, but small and mids are trading at also 18, 15, 20 PE, the gap is likely to widen. So this mean reversion of valuation anchors our expectations around how to overweight a particular capitalization.
But what I understand is, sir, in multi-cap fund, you have to have minimum 25% investment in each cap, mid-cap and small cap.
At all point of time, I will follow SEBI regulation of 25% each in large, mid and small, and balance 25% we will allocate in large, mid or small, depending upon how this model indicates.
Sir, as far as the valuations are concerned, you just spoke about the valuations. For large cap, if I talk, the valuations seem to be stretched. I mean, some of the stocks are trading at 60 multiples, 50 multiples. Would you be buying these stocks at these multiples?
So, Neetu, it's all relative to their historical average, their return on equity, And what do we define by way of earnings? When I was very, very young investor early in my career, I missed a FMCG company whose P ratio was highest. And I thought that since P is so high above its historical average, let me avoid it. What my analysis didn't indicate to me that this company earlier used to spend 5% of sales in advertising, and now because of competition, they were spending 20% of sales in advertising. Now, 20% sales on advertising is not going to sustain forever. More importantly, that spending had created a brand for this product and it was deterring other people to launch. Over a period of time, the company's advertising to sales ratio came down from 20% to 6-7%. Profitability went up, and the P ratio, which was looking expensive when advertising was 20% of sales, became fairly low when advertising normalized. So just at high P, should you not invest? Answer is no. You'll have to go into the details to find out why market is willing to give this high P, and do you believe company will deliver better than the expectations of the market?
Talking about the mid-cap space, sir, it has been very exciting last 1.5 years for mid-cap and small-cap both. Do you find value and offer, do these offer value at current levels only also?
Gitu, this is fairly priced market.
Yeah.
Now value will not be available. This is, like going to a departmental store. सेल्स चल रहा था तो सारी चीजें आधे दाम पे मिल रही थी. सेल्स खत्म हो गया तो आपको प्राइसेस अपने लेवल प्राइस पे मिल रही है. Now you can't be complaining that now prices are no longer cheap. Well, that was available in March, April, May 20 when the whole market was on a discount and everything was available below fair value. But market does not keep that window open forever. There are windows like today where you have to pay fair price because there is no sale in the market. So this is the market where it is fairly priced, fully priced, and you will have to be a growth investor rather than value seeker.
One of the key risks that you think markets would face in times to come, I mean, we are talking about tapering, and the US Fed has indicated that they may start by the end of this year. Will this really impact emerging markets? And what is the difference between the scenario that we saw in 2013 and 2021?
So, Neetu, in some sense, 2030 was Bakhaya story of our childhood. Yes. Fed said that we will do taper tantrum. They were guiding market. The over-enthusiastic people jumped on it saying that now the sky is falling. Before taper tantrum started, they brought the market down. But when actual taper tantrum began, Fed was withdrawing liquidity in calibrated manner and managed interest rates transition in a gradual manner, and markets did not witness any impact. This is like a doctor coming to a patient and saying that now you are recovering well, and in few days I'm going to take out your ventilator. The patient's family can start jumping with joy that now our patient has recovered and ventilator will be removed, or they can start crying that without ventilator patient will die. What do you think is more reasonable reaction? Well, if you have faith in doctor, you know when he will remove ventilator. So, in my opinion, central bankers are expert doctors. They have revived the patients by providing high liquidity and low interest rates. They have worked with government to provide fiscal and monetary stimulus to stabilize patient. They will not withdraw the stimulus so early that patient dies. They will ensure that patient has recovered well enough to walk on his own or on her own and then withdraw this. So I don't see material impact from taper tantrum based on 2013 experience and based on this confidence of investors that Fed and other central bankers will be calibrated in their approach. Now, this whole thing can be viewed from a different point of view. If our markets are expensive, let's say 20,000 Nifty, taper tantrum will create bigger reaction. If we are at 15,000 Nifty, taper tantrum ko dekhega bhi nahi.
बिल्कुल सही. So last question, China disruption, how is it going to benefit India in the long run?
I think it's the greatest opportunity for India. In 1980, India and China were of similar size. They caught the bandwagon of manufacturing to the world. They created incredible amount of work in terms of infrastructure, in terms of building capacities, in terms of lowering cost. And because of that incredible work, they are now 5 times bigger than us. We missed the bus completely. And now God is giving us an opportunity which we should capitalize with both hands. The world has seen China's emergence as a threat. Their behavior in Wuhan virus episode is debatable. Their fights with the neighbors is also quite difficult to comprehend. And which is where globally manufacturers wants to diversify out of China. The entire world is after them, from Korea, Taiwan, Philippines, Indonesia, Thailand, Bangladesh, Vietnam, Mexico. Every country is after them. But all these countries put together does not have domestic market which is as big as ours. We have to lay a red carpet for this China plus one strategy. Let manufacturers come to here. And like Suzuki's entry created big growth, export surplus, millions of jobs in India. We should aim to create that through PLI scheme in textiles, automobiles, auto components, bulk trucks, electronics, electricals, mobile handsets, and so on and so forth. I think we can narrow the gap with China if we capture this opportunity well. And we have done this in services where India is back office to the world, thanks to our IT and BPO companies. Let's replicate that success in our manufacturing sector. There are some people who say that, but services are different, manufacturing is different. But we have become generic pharma provider to the world. The world's largest vaccine maker is in India. Some of the largest generic pharma companies are in India. So even in manufacturing, we can be successful if we put our might together. So this is the best opportunity for India to ensure that the mistake of 1980 is not repeated, and we capture this opportunity of China plus one to close gap with China.
Thank you, Mr. Shah, for your time. It was a pleasure speaking with you as always, and we wish you best of luck for your new fund offer.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.